Hi, I'm Matt Dicken, and this is Strategic Wealth. On today's show, all right, what I wanted to talk about this week is basically who do we work best with as a firm?
Yeah, it is guaranteed. It's guaranteed by the strength and stability of the company that you're investing in.
Well, that really depends on the situation. That's just a little bit of what you're going to see right now. Welcome to this week's show. Thank you for watching once again. We've got a brand new segment that you want to make sure that you stay tuned to. We're going to have a lot of fun with it. We have a lot of great information we're going to bring to you once again this week. So let's not waste any time. Let's go ahead and get started with this week's Money Minute. This week, let me share with you a story that happened with one of our clients that gave us a call. She has a child that's getting ready to go to college here at the end of the summer. And she was asking me which accounts should she pull money from to pay for the tuition. So we sat down and we took a look at the numbers, and I came to the conclusion that she really could not afford at this point in her life to pay for the college tuition. What had happened in this particular individual is not unlike what's happened to a lot of individuals through the recession, and that is that she's spent a prolonged period of time out of work. She's lost some money in her investments prior to working with us. She's had a pretty difficult last few years. So the money that she thought she was going to have for college just wasn't there. So we took a look at it and we basically ran some numbers and said, well, if you take the money out of your retirement accounts right now to pay for your daughter to go to school, you're going to run out of money basically in your 60s when you go into retirement. So at that point, she really doesn't have any options. You know, if she were to run out of money, she'd either find herself having to go back to work possibly, or maybe the other alternative is she could just move in with her daughter at that point. So you have to take an honest look at when tuition bills come up as far as can you really afford them. Now, we're not saying don't send your children to school, but you do have to take an honest look at can you really afford to do it. If you can, there's probably no better investment than a great education for your child. But in some cases, we'll see individuals where if they actually pay for the full tuition, 100% of it, or go on the children go on to grad school, things of that nature, it's actually going to deplete their retirement accounts, and they really find themselves in a situation where they can't afford to pay for it. Now, let's say you find yourself in a situation where you truly just cannot afford the college tuition. It's not as if your child can't still go to school. There's lots of alternatives. You know, one thing they could possibly do is get a loan. That's not ideal, but it's better than not going to school. They could certainly work through school and pay part of the tuition on their own. Maybe starting at a community college would be another alternative. There's several different options that they have. Now, going back to the particular client that I talked with this past week, she basically sat down with her daughter and said, look, I can pay for your college tuition, but the alternative is going to be about the time that you're having a child, maybe when you get married in your early 30s, I'm probably going to have to move in with you, and you're going to have to support me because I'm going to run out of money. Once she shared that with her daughter looked at her and said, you know what, Mom, don't worry about it. I'll figure out an alternative. So before you make these decisions, it's best not to go it alone. Before you start paying for the tuition or really any major expense, it's best to talk with a financial advisor and see how that's going to impact you not only today, but maybe 5, 10, or 15 years in the future. Now let's talk a little bit about our Facebook poll. And while you're visiting our Facebook page, please be sure to like us and take a look at any of our past articles. You know, we've got a lot of great information that we put out there each and every week. Spend a little time taking our poll or any previous polls, but also spend a little time educating yourself and reading through the articles. This week we're asking you, do you believe income taxes are going to rise in the future? Yes or no? And while you're there, be sure to sign up for our newsletter. We send this out to all of our clients and thousands of our viewers and listeners. In the newsletter, you're going to find valuable information that you can use about retirement planning, taxes. We'll give you some insight as far as what's going on in the office, and typically we'll have special events that we'll invite you to. The newsletter is free and easy to sign up for, so please do that while you're on our Facebook page. And now it's time for X's and O's with Coach Matt. Come on, let's go. All right, what I wanted to talk about this week is basically who do we work best with as a firm? You know, with having the TV show, we've been having a lot of individuals call us and saying, Matt, are you the right advisor for me? Who do you work best with? What do you specialize in? And we always say up front, you know, we can't help everybody. The type of things that we specialize in and focus in isn't necessarily for everyone. But when we can help someone, there's basically three main things that we're going to focus on or that we basically have to agree on as far as what our priorities are going to be. Now, primarily, we'll work with those that are retired or soon to be retired, meaning they're within about 10 years of retirement. So typically at that point in your lives, safety becomes a bigger priority. So safety is our number one goal when working with someone. We don't want to lose any money. We don't want to have any fear of losing money because individuals are too close to retirement, maybe already retired. They don't have time to make up for market drops like we've seen in the past. So safety has to be our number one priority. Now, in addition to keeping their money safe, individuals want to see it grow by a reasonable return. So that's kind of our second priority, is basically reasonable returns. Now, we define reasonable returns to mean that we need to average returns of somewhere between 6 and 10% per year. That's what we consider reasonable. Now, when we earn more than 10%, which occasionally happens, we'll celebrate. Nobody's ever unhappy that occurred, but typically over time, we're going to be somewhere between 6 and 10% per year on average with no negative years. That's what we consider reasonable. The third thing that we need to do is we need to try and keep things as simple as we possibly can. We meet with individuals all the time where they're getting 20-page monthly statements, maybe 60-page quarterly statements. They get these statements in the mail. They have no idea what they're looking at. So we want to keep it very, very simple. With us, if things are going up in value, if it's a good economy, you know you're going to get a reasonable rate of return. But if things are going poorly and the stock market is falling, the economy is struggling, you know basically you have a safety net on your account. You don't necessarily have to worry about anything. So when we can help someone, it's because we want to accomplish these three main things. Now, the next question that we'll always get is, well, Matt, how do you accomplish that? All right, let me give you an example of what we're talking about. Basically, as an investor, there's different places that you can put your money. So if we try and plot this on a graph, now as you can tell, I'm not an artist, so hopefully all of this will make sense, so just bear with me. But if we were to plot on a graph where we invest our money, obviously over time it's going to react differently. So one place that all investors can invest their money, obviously, is in individual stocks. So let's just assume that this black line here represents having money invested directly in the stock market. So we know money in the market over time, sometimes it goes up in value, sometimes it goes down in value. What we're hoping for is that over time we have more money than what we started with. And sometimes that works, unfortunately, other times it doesn't. Now what a lot of individuals will do is they'll say, well, Matt, I don't know what individual stocks to pick, so I would prefer to have my money invested in a mutual fund. So if we were to graph mutual funds here on the board, basically a mutual fund is going to kind of look like this red line. Okay, so it'll basically mirror the performance of the stock market a little bit, but it will typically lag it. There's usually a little bit of a separation. Now we talk about in our educational classes all the time that mutual funds about 80% of the time will underperform the index or the benchmark that they're trying to beat. So they'll usually lag the overall market. Maybe sometimes it's because of performance, but the bigger issue that is typically causing mutual funds to underperform direct investment in the market are the fees that they charge. Typical mutual funds going to have annual fees maybe somewhere between 1 to possibly as high as 3% per year. When you look at management fees, trading costs, possibly advisory fees, they can get pretty expensive. Now you never get a bill or an invoice for the fees that they charge, and you never see these fees deducted from your account statement because they're basically a hidden cost. Okay, they take it directly out of your performance. So let's walk through an example. Let's say that you have money in mutual funds, and let's say you're paying 2% per year in fees, which is pretty common. What will happen is when the stock market rises by 10%, you don't go up by 10, you would only grow by 8% because of the fees. Now when the stock market loses 10%, you won't just lose 10%, you'll actually lose 12% because of the fees. So actually what happens is over time, there's a compounding effect to those fees. The spread starts to get greater and greater and greater. Now we mention all the time that we're not against mutual funds completely. A great time to invest money in mutual funds is when you have what's called an active account, meaning that you are putting money into mutual funds or into your account on a monthly basis. Maybe like a 401k or an IRA, some sort of a 403b, whatever you might have through your employer. Any account that you're putting money into on a monthly basis is what's considered an active account. The reason why that's not a bad time to use mutual funds is because as the market's going up, and certainly when it goes down, you don't get excited that the market fell in value, but you're still buying. You're buying along the way. You'll buy more shares at a lower price that'll help you recover more quickly when the market goes up. So you're taking advantage of the volatility. A time that you typically want to avoid having money in mutual funds is in what's called a dormant account. Now, a dormant account is any type of an account that you are not putting money into mutual funds. This is where we don't want to invest in mutual funds. So a dormant account could possibly be a previous employer's retirement plan that you haven't rolled over to an IRA, or maybe it is an IRA that you're not contributing to on a monthly basis. What happens on those accounts is when the stock market goes down in value, you're no longer taking advantage of that volatility. You just lose money. And then you have to wait and hope for the account to grow in value and go back up. And because of the fee structure, that can be very difficult to get ahead and stay ahead. So in our office, we're not against mutual funds completely. They definitely have a time and a place. You just have to know when to use them and certainly when to avoid them. And you want to avoid them in dormant accounts. Now, if you have dormant accounts, a lot of times the question will come up, well, Matt, where should I put my money? If we were to take a look at maybe what the banks are offering right now, that would certainly be a safe place to put your money. Pretty simple to understand what the banks are offering to us. So let's say we'll put banks as an option up here. Now, anything that the bank has to offer, typically, like we just said, is going to be safe. CDs, money market accounts, as long as you keep the money insured, you don't have to worry about, or below the insured limit of $250,000, you don't have to worry about losing anything. It's pretty simple to understand a money market or a CD account, but right now they're just not returning a reasonable rate of return. So that's what I've got it right down here towards the bottom. They're just not paying very much. So an alternative that we'll talk to individuals a lot about when they come into the office is the indexed annuities. And the reason why we'll talk about those accounts is because I think they're probably one of the best kept secrets in the retirement planning market. I just don't hear enough people talking about them. And even if they're talking about them, a lot of times they don't truly understand exactly how they work. So basically with the index annuity, as the market grows, you're going to grow with it. We don't have any fees that we have to worry about, typically, because the company that your money is on deposit with is going to make money on your money while you leave it with them. So we don't have to worry about high fees or expenses. However, there is going to be a maximum that you can earn in the good years. They'll set a limit to how much you can earn when the market goes up. And depending on the account that you have money in, there's maybe upper limits of 8% per year to possibly as high as 20% per year. So what that means is however high the market goes, you can only do as well as whatever your limit is. So let's say in this example, the market grows in 1 year by maybe 20%. Let's say that you have a 15% maximum gain on your account. So you can't grow by 20%. The most you would be able to earn is 15. So let's say we run into a ceiling. Now again, the reason why they put that ceiling there is because when the market goes down in value, both your principal and your growth is always protected. So we don't ever have to give back what we had earned in the previous year when that's followed by a bad year. Okay, you might not make anything, but more importantly, you don't lose anything. You've got a good safety net on the account. Both principal and growth is always protected for you. Now, if we go back to the stock market once again, when the stock market starts to grow, on a mutual fund, if we lost money, we have to wait until we get back to even before we start to realize any growth. Okay, so mutual funds wouldn't be bad if we could lock in our gains, but we can't. So when we lose money, we have to wait till we get back to even to see any gains. On the index annuity, we are always even. We never lost any money at all in the first place. So as the market starts to rally and recover, we just take off right where we left off. Our account grows up to be this limit or this level now. So when we experience another decline in the stock market, we would maintain. We would go sideways again because we've got a safety net. And again, that's basically how the index annuities work. So over time, what we're doing is we're taking advantage of the upswings in the market without having to participate in the downswings. Now, of course, you don't get all these great benefits without a couple of strings that are attached. And I already mentioned one of them. First thing we have is we have a maximum amount of interest that you can earn in the good years. Again, you're capped. You have a limit. You never participate in the downturns of the market, so companies are going to set a maximum that you can earn in the good years. Typically, once again, that maximum that you can earn is usually somewhere between 8 to possibly as high as 20%. Now you'll know what that maximum is before you invest money, but it just depends on the account that you select. So that's the first string that's attached. The second string that's attached is something that's called time. You have to agree to a certain amount of time before you withdraw all of your funds. That's why there are no fees, kind of similar to a CD. There's no fees on a CD. It's not as if the bank is doing it for free. They're making money on your money while it's on deposit with them. That's why they don't charge any fees. The same thing is true with the index annuity account. You're making a time commitment, meaning there's a certain period of years before you withdraw all of your money. That's why they don't charge fees. They're going to make money on your money while it's on deposit with them. The sweet spot in the marketplace as we see it is somewhere between 4 and 10 years. So if I'm working with somebody that has at least 4 years before they want to withdraw all of their funds from their account, the index annuity might be appropriate for them. Now, even if you need to withdraw funds prior to the end of this 4-year period, you can take part of the money out each and every year if you need to or if you want to, but you don't have to. But what you can't do, unless you're willing to pay a penalty, is come back and withdraw 100% of your money until you get to the end of the 4-year period. There's a couple of exceptions to that. If you have any type of major medical emergency or a premature death, then you can take all the money out typically at any time. But it's got to be something serious. So you're typically going to make some sort of a time commitment at a minimum of 4-year commitment to as much as a 10-year commitment. Now again, similar to CDs, the more time that you agree to, the better the accounts can perform. But this is one way, there's other options, but this is one way that investors can keep their money safe, because there's an automatic safety net on the account. They can keep their money safe, but still see it earn a reasonable rate of return. Again, we're taking advantage of the upswings, not participating in the downswings. We're giving up some of the upside potential to, on the flip side, have none of the downside risk.
Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com. You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television.
It's that time again for our tip of the week. In this week's tip, I want to talk a little bit about variable annuities. From time to time, you will hear individuals saying, don't ever put money into annuities. Typically what they're talking about are variable annuities. And the reason why they're saying that is because the annual fees and expenses can be absolutely outrageous on these accounts. A typical variable annuity is going to have annual fees somewhere between 2 and 6% per year. I've actually seen them as high as 8%. Now that's rare, but I've seen it. What we see in our office is an average just under 5% per year. So let's take a look at it in an example. Let's say you have $100,000 in a variable annuity. Let's say you're paying an average fee of just under 5%. That means that you'll pay about $5,000 per year for them to manage the account. The big problem that I have with these types of fees is that's not a one-time charge. They're going to charge us every single year. So over a 10-year time period, you could lose as much as $50,000 in fees on just a $100,000 account. In my opinion, these are one of the biggest ripoffs that we see in the financial services industry. Now, if you have a variable annuity, you can schedule an appointment with us in our office and we'll find out exactly what the fees and expenses are that you're paying. We can even, if you'd like to, call the 1-800 number that's maybe on your statement when you come into the office, because we've got a speakerphone in our conference room. With your permission, the company will talk with me, and I know what department to get to and what questions to ask. It's not uncommon for us to meet with individuals where they will come in with a variable annuity and they'll say, well, Matt, I think my advisor told me I'm paying somewhere around 1 or 2% per year. And I'll just say, well, let's double check it. You know, I've never seen it below 2% per year, but there's a first time for everything. So I'll say, let's just call the 1-800 number and double check things. Usually takes about 5 or 10 minutes. We'll find out that individuals are maybe paying 3% or 4%, maybe as high as 6% per year. It's usually much higher than what they thought. So again, you typically want to avoid having money invested in variable annuities. They're just too expensive and too costly. Now the good news is, about 9 times out of 10, when we see individuals that have money invested in variable annuities, we can fix them and it doesn't cost them anything. Because I'll meet with people that will tell me, well, Matt, I feel like I'm stuck. You know, I signed up for a certain number of years, or if I take money out of this account right now, I'm going to get hit with a surrender charge or a penalty or something of that nature. About 9 times out of 10, we can get around those things. Now, we cannot do it 100% of the time. And if we couldn't do it, we would have to say, we're sorry, we just can't help you in this scenario. We'd maybe look at some other alternative. But most of the time, we can fix those accounts. You are not stuck with them. So if you don't have money in a variable annuity currently, please do not put money into a variable annuity. And if you do have money in one of these accounts, give us a call and let us find out exactly what your fees are that you're paying. And that's this week's tip. A few weeks back on the radio show, we talked about how to have guaranteed income for life. Let's take a look at that.
You know, Matt, one of the biggest questions we've gotten on the show here, and I believe it was prompted by one of the financial authors that you had on. I believe the book was named The Pensionless Society. It's there are fewer and fewer folks retiring with a pension. and people are they're hungry for knowledge about, is there something that I can do that will guarantee my income for a lifetime? And yes, there are some things out there, and maybe you'd like to expand on that a little bit.
Yeah, one of the questions that we ask at our financial workshops that individuals can attend is, what is your number one financial concern? And running out of money is the top response to that question. And I think it should be the top response, because studies have shown that about 65% of the time that when individuals retire, they're going to actually retire without enough money to maintain their standard of living.
You know, Matt, it was funny because I believe one person actually raised their hand and said, living too long.
Yeah.
And I thought, well, no, they've got it backwards. You don't live too long, you run out of money.
Right. So, running out of money actually is individuals' number one fear overall, not just financial fear. It used to be public speaking, but now running out of money, and studies are showing that that's everybody's number one fear, followed by public speaking, followed by death. So it is a big issue, and like you mentioned, we've talked about it here on the show in the past. It used to be that individuals would go to work for a company for maybe 20, 30, 40 years maybe in some cases, and they knew that when they retired, the company was going to take care of them through the use of a pension plan. And for the most part, those types of plans have gone away. You're still seeing them in some cases, but they're being eliminated primarily in the private sector, and now they're even coming under scrutiny in the public sector as well. So I think moving forward, it's going to be up to individuals themselves to try and find ways to provide this guaranteed income for life. Individuals can still have a guaranteed income for life, and one way of doing that in today's environment is by the use of an annuity, Mark. Now, a lot of times individuals will say, an annuity, wait a minute, I always heard that those were bad. And a lot of times why individuals will say things like that is they might be used to the old annuities that were available only for previous generations, like maybe something that was called an immediate annuity. And basically the way that worked was you gave a pile of money to an insurance company, and they're going to give you some sort of guaranteed income, but if you passed away early, they basically kept it all. So if you had a premature death, it wasn't a very good deal for your beneficiaries and your
There's
heirs.
nothing like that today.
Well, they're still out there, but the vast majority of annuities that are available now do not work like that. The vast majority of them will provide some sort of an income for you, but if you pass away, whatever money is left in the account should pass on to your heirs and beneficiaries. It's a good question to ask if you're interested in investing in an annuity, but most of them don't work like the old ones.
Matt, I have found that time and time again, almost every night when you do your seminars, and you ask people specific seminar questions, not only do you have less than the half of the room that says they know the answer, at times nobody's raising their hand. So it seems to me that there are a lot of questions out there when it comes to annuities, because how many different kinds of annuities are there?
Yeah, well, you can have the immediate annuity like we just mentioned, but you have others that are what's called deferred annuities. And those are the ones that you would really want, okay? Those are the ones that if you pass away, whatever's left in the account will go to your heirs and beneficiaries. So really what it falls into is really kind of three different categories. You have variable annuities, which we're not big fans of. Typically the fees are very, very high on a variable annuity, anywhere from maybe 2 to 6%.
Matt, a lot of people have those variable annuities.
A lot
we
of
get
people
a
have
lot
the
of
variable
questions
annuities.
and a lot of calls about variable annuities.
Yeah, we're not big fans of them because there's too much risk associated with them, and the fees are just too high. On average, probably 4 or 5% per year is what we see. So to put that into context, let's say you have $100,000 in a variable annuity, you could be losing $4,000 to $5,000 a year in fees. So over a 10-year time period, that's how much? That's $40,000 to $50,000
On a $100,000 investment.
Usually not a very good deal.
Ouch.
You have fixed annuities, which are kind of the opposite of a variable annuity. With a fixed annuity, you're going to have some sort of guaranteed interest rate and no fees, and you don't have to worry about losing anything. Now, the thing that you need to watch out for in the fixed annuity is whatever rate of return you're going to get is only as good as the guarantees that are available today. And in today's environment, about the best you can find on a fixed annuity is going to be about 3 to 4%. So nothing to get overly excited about, but 3 to 4% in a safe environment might not be bad when you compare it to some of the other alternatives.
Well, let me ask you, is that a guaranteed item? Because that's what we're talking about today, guaranteed income.
Yeah, it is guaranteed. It's guaranteed by the strength and stability of the company that you're investing in. So you want to make sure you're dealing with a highly rated, highly regarded company. There's also, depending on the state that you live in, there's basically a backstop. So it's called the Guarantee Association Fund. So if a company were to go out of business, you'd have some level of protection there as well. Another alternative would be the index annuity, and we do a lot of work with index annuities in our office because with these accounts, they're kind of a combination of maybe the variable annuity along with the fixed annuity. You have the safety and security that you don't have to worry about losing any money, but you still have the potential for a higher rate of return when the market does grow. So you get to participate in the growth of the market without having to participate in any losses in the market, as long as you're okay with agreeing to a certain amount of time before you take your money out of the account without a penalty. And certain index annuities today will have what's called income riders that will guarantee that you will have growth on your account of anywhere from maybe 4% to maybe as high as 8%, depending on the situation and depending on how much time you have to agree to before you take withdrawals. So if you have an environment where you can get somewhere between 4 and 8% in a very safe, guaranteed way, this can help you make sure that you're going to have income that will basically last you the rest of your life. It's one option that's available.
Matt, before we head to the break here, I know that you authored a publication about annuities last year. Why don't we take a moment before we head to break and tell our listeners about it?
Well, for those that want more information about the index annuity specifically, we did author a buyer's guide. Anybody that wants to call into the office and request a copy of it, it'll tell you what to look for in an index annuity and what to avoid in an index annuity.
All right, everybody. You're listening to The Matt Dicken Show, where safe money is smart money.
Now, before we wrap up this week's show, I want to remind everybody that we've got a great resource that you can use in helping you find and determine who the right advice givers are that you should be working with. We get the question all the time, Matt, is my financial advisor the right one for me now? Should I switch to you? Should I find somebody else? It really depends on your situation, but that's why we created this particular report. You can request it by going to our website or giving us a call directly into the office. We're happy to provide it to you. It has questions that you should ask your advisor, as well as questions that you should ask yourself. So that's our show for today. Once again, thank you for tuning in and watching. And remember, retirement planning is a journey, not a destination. We'll catch you next time.
Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com.